Hello everybody! I had a subscriber who wrote thoughts on WRK, VGR and SBGI, and a small disclaimer, I do not know these companies, but I thought why not try to make a video about it and just tell them how I see them based off the numbers. So if we jump into our stock screener here and just write WRK, we get WRK company, apparently is a fiber-based paper and packaging solution company. Over the last year, they are down around 30%, and the price to earnings forward non-GAAP ratio is around 9, which is a bit lower than the 5-year average. The payout ratio is 30%, which is quite healthy. It also just has a very, very low short interest, and it's pretty close right now to its one-year low, actually. It's just slightly above. The analyst target price is $38, so there could be room for some growth. They do also have a bit of EPS growth and return on equity. Not quite as high as I like it, but still it's there, so it's not to be completely disregarded. But if we jump into our dividend stock data here, we can see that if we zoom in a little bit, they do offer a dividend yield currently of around 3.7%. They actually have a pretty nice growth rate, I would say. You can see even some of the years here where they had so they actually dropped their dividend in 2020 by 40%, and then actually the year after they dropped it even further and then started to go back again. Okay, can make sense with the payout ratio could be a bit high at that time. They're actually above right now 1.10 compared to $1.07 back then. The dividend growth rate over the last 3 years is they have been growing it a little bit. Over the 5 years, obviously, it's not that big since they had the big dividend cut around a couple of years ago. But over the last 10 years, totally, it's 8.7%. But you can see here, back in 2015 and 2014, they had a massive growth of 50 and 76%. So definitely a company that could be interesting just based off this, but you might want to take some considerations going into it. If we jump down here a bit, it could be that there is some discount to be had based on dividend yield theory at the current time. You know, when it's in the blue, it's supposed to be undervalued, and according to this, around 16%. And when we're in the red, then it's definitely overvalued, again, based on dividend yield theory. But for WRK, I think it could be an okay-ish time to go in, based obviously on a total picture that I don't have here. But just based off this, it seems pretty okay. So let's jump back again here and take the next one, which is VGR or Vector Group. Let's zoom out a bit again here. So current price around $12. Vector Group, obviously the tobacco company. So over the last year, you can see the one-year performance is up around 15%, which is to be expected in very volatile macroeconomic environment where investors seek some safe havens, which tobacco companies usually are. P non-GAAP forward ratio around 8. The dividend yield is 6.7% roughly, and the payout ratio is around 80%. Again, for tobacco companies, it's probably okay to be that high. I know they usually roll with a pretty high average goal or target for their payout ratio compared to a lot of other companies. The 5-year low and the 5-year high, so it's pretty much dead even in the middle right now, and it does have an analyst target price of about 15, so it could be a little bit of capital appreciation on top of it. They do show a pretty nice amount of EPS growth, but no return on equity growth, unfortunately. And if we jump into the dividend data tab and zoom in a little bit more here, once again, they have also in 2020 slashed the dividend quite severely, almost 50%, going from $1.54 to 80 cents. And that they've actually kept for 3 years now, so almost no dividend growth at that time. So over the last 10 years, it's actually a negative for 3.5%. And over the last 5 years, it's a negative 11%. So based off this, it doesn't look too good already. But let's try to go down a little bit and see whether or not it could be okay. If we come down here to the 5-year dividend yield, you can see here, as mentioned before, when we are in the red, it's definitely unvalued according to the dividend yield theory. And also you can see over here that there is not any discount to be had at the current time. Again, based on dividend yield theory, combining the high payout ratio with the high yield, comparing this to it being pretty undervalued and the dividend hasn't grown anything, I would probably steer away from this. I think this dividend is highly unsafe just based off of this. So I would definitely look into other stocks. Again, let's jump back to the dividend screener and try to punch in the last one, which is SBGI, which is Sinclair Broadcast Group or something like that. Yeah, Sinclair Broadcast Group, a media company in the United States. And over the last year, down around 50%. So again, doesn't look that well at all. A PE non-GAAP 4 ratio of 3.7, which is extremely low. So not too much faith in the future from investors here. You can see dividend yield is around 6% and the payout ratio is 2%. So this is definitely something I would double check to if this is true at all, because that sounds extremely unlikely. With the current price being $14.64 and the 52-week low as $14.37, this is also pretty close to a one-year low. The analyst target price is $23. So again, if this is true, there could be some capital appreciation in it. They do have EPS growth of very high, 65%, and return on equity of 362%. So these numbers to me just is a bit like too skewed, I think. So I would definitely double check these with whatever source or portal you prefer. But some of these seems a bit unlikely. So this is definitely something to keep in mind. But if we jump into the dividend data tab and zoom in a bit, we can try to see if there's anything here that looks too weird or too unfamiliar. I think it looks pretty okay. You can see here the dividend growth. They had some years where they didn't grow that much, where 19, 20, 21, they didn't do anything really. But other than that, they didn't slash it. They had a pretty high growth in 2022, 25%. And other than that, I think it seems fairly okay. A 10-year growth rate of just over 5%, a 5-year growth rate of around 6%. So not an extremely fast grower, but still it is growing quite nice. And it also offers a dividend yield of 6.8%. Again, combining the yields at all-time low with the with this kind of growth, you can see it's from 25%. I think there could be a dividend slash in the future unless something happens with the stock price, obviously. But if you come down here, you can see that it's okay around, according to the dividend yield theory, this is at a massive value right now. You see 47% discount. Mentioned earlier a lot of times, when we're in the blue, that's where we want to be. That is when we could expect it to be undervalued. Obviously, need to look deeper into it. But just looking off of this, I think it looks pretty undervalued. And with the dividend stats it has, I think this is definitely something one should look deeper into. I think if you're doing it for the income, I think it combines a pretty nice safe spot right now for a high yield with a little bit of growth still, if they can keep that up. So if they get back up with a bit of capital appreciation, I think it could be a pretty good stock to have. Again, just based off these numbers, I don't know the company, and also you would definitely need to do your own due diligence before buying, obviously. But thank you for the suggestions, Tonje. I hope you like the video, and if you don't support the channel already, please like the video and subscribe to the channel for more videos in the future, and I'll be seeing you in the next video.